From tech giants reinvesting billions of dollars of profits into R&D such as Tesla, Shopify, and Meta platforms, to the most widely known consumer giants such as Coca-Cola and Target, growth and dividend stocks vary by their inherent nature. In essence, dividend-paying companies are well established in their industry and provide dividend payments as a continuous income to their investors in exchange for slower company growth. While growth companies have a greater potential to rapidly increase their company valuation, but in the process reinvests their free cash instead of paying it out as dividends. However, there are a lot of other aspects to consider. So, let us delve into the specifics and examples of each before you make your investment decision. Qualities of dividend stocks. Large companies with established products and branding often pay out a hefty portion of their excess cash flow, usually from revenue as dividends to their stockholders. This often signals that the company is doing well financially and is a less risky investment by nature. Investors are often attracted to their greater stability and proven track record compared to volatile growth stocks. To be more precise, a dividend stock investor would often prioritize one or more of the following goals: getting a constant source of dividend income from equities, gradually increasing the size of the dividend revenue stream, and long-term stock price appreciation. Many dividend investors strive to balance these three goals by investing in dividend growth stocks, a firm that pays out dividends but also focuses on investing a portion of their cash back into the company. Others prioritize one goal above the other. For example, consider an investor who is now focused on generating the most dividend income. They will likely gravitate towards companies with the most solid dividend yields. On the other hand, an investor seeking a balance between present income, income growth, and capital appreciation would like to invest in firms with lower dividend yields and a great track record of growth. Each year, they increase the value of their dividends distributed to stockholders. Let's take a look at several dividend stocks that meet these criteria. Tobacco company Altria is an example of a high dividend yield stock. As a result of governmental campaigns and social awareness, smoking rates have fallen drastically over the decade. This makes the tobacco sector relatively saturated with poor growth potential. Investing in Altria provides investors with immediate access to significant dividend income. However, the prospect of substantial dividend growth and share price appreciation will almost certainly be sacrificed within Altria's slowing industry. Another example would be real estate investment trust companies, which are also classified as having greater dividend yielding and lower growth. Many dividend investors favor them. We also have stocks like Apple with lower dividend yields on the other end of the range. Apple's dividend yield is usually less than 1%. Dividend investors seek out equities like Apple for a variety of reasons. One of the biggest reasons is that despite the low dividend yield, Apple stock has a higher average appreciation rate due to their aggressive reinvestments into their products, such as the iPhone. Many investors of Apple emphasize less on passive dividend income and more on the growth potential of the company. Finally, numerous stocks lie somewhere in the middle of these two extremes, with dividend yields ranging from 3 to 5% and a regular increase in their share dividend rate yearly. Many of these companies also focus on reinvesting a portion of profits for further growth. PepsiCo is an excellent example with a dividend yield of 3.68% in January of 2022. What to look for when choosing between dividend stocks? Dividend investors often consider many critical indicators when choosing which dividend stock to include in their investment portfolio. The key factors to consider are: number 1, the dividend yield on the stock, the amount of yearly cash dividends received by an investment, expressed as a proportion of total investment. Rate of dividend growth, the yearly percentage rate at which management raises the dividend. History of dividends payout, or the duration of a company's dividend payments. Companies with a 25-year consecutive history of paying out dividends are known as dividend aristocrats, while 50-year consecutive firms are known as dividend kings. They are an excellent place to begin when constructing a dividend portfolio. And lastly, the dividend payout ratio of the firm, the amount given to investors in exchange for a company's financial resources. The benefits and drawbacks of dividend stocks. Benefits. In a poor market, Dividend stocks beat growth equities as dividend yields increase while stock prices decline. As a result, it protects against additional reductions. To get money from a dividend portfolio, you do not need to sell the stock. Thus, you can continue to earn dividend income while investing in the company. Dividends are kind of a passive income because you automatically get a share of the dividend by simply holding the stock. Additionally, dividends are taxed at a reduced rate compared to your regular income tax. Drawbacks. Unlike growth stocks that don't get taxed until you realize the gains, dividends are taxed in the year that they are received, even if the dividends are reinvested in the stock. Businesses are not compelled to pay dividends. As a result, they can lower or terminate their dividend payment at any moment, even though the finest dividend stocks rarely do so. Many dividend stocks are concentrated in similar stock market sectors and businesses. As a result, constructing a diverse investment portfolio may be difficult. Investing in growth stocks. What exactly is growth stock investing? The main goal of growth stock investment is capital appreciation. Growth investors purchase a stock anticipating that the future share price will increase. As a result, growth stocks are often overpriced in terms of share price to business profits due to larger amounts of speculation towards the company's future prospects. Certain firms such as Tesla have a PE ratio of over 70, meaning you have to pay $70 to expose yourself to just $1 of the company's earnings. A growth investor, unlike dividend investors, is unconcerned about whether a firm delivers a dividend. In many cases, they will choose a company with no dividend as they hope that all profits are reinvested back into the firm for a faster growth potential. Thus, growth companies are expected to appreciate their valuation much faster than dividend stocks, causing the share price to also increase considerably. Examples of growth stocks. Neither of these two companies has paid a dividend to shareholders. However, their share values have climbed dramatically throughout the 5 years ending in 2021. First, we have Netflix, whose stock soared from 250% from 2017 to 2021 due to the increased demand for movies as the pandemic rolled around. Currently, the 10-year growth of Netflix's stock is staggering 1,750%, which means that you would have to nearly multiply your initial investment by 18 times if you purchased Netflix 10 years ago. We also have Amazon, whose share price rose 233% from 2017 to 2021. If you had bought the stock and held it 10 years ago, you would have 12 times your money. This rate of appreciation is something that you can never hope for in dividend stocks. However, we also have growth companies such as PayPal, whose stock tumbled nearly 40% this year. Although your reward may be huge, your potential losses are also much greater. What to look for when choosing growth stocks? Revenue growth. Without a quickly expanding income stream, it is difficult to ensure that a firm's future prospects will keep up with trends in inflation. Rising profits. Promising earnings are one of the most effective confidence boosters for growth investors. Expanding capabilities. Growth in future capacities may push growth stock values upward without sales or profits. Amazon, for example, was unprofitable for many years, but it was expanding its technology and distribution infrastructure. Management capable and trustworthy. You are trusting that the company's management will intelligently invest your money in expansions that will boost its stock price, but not blow it all away. The benefits of growth investing over dividend investing. The possibility of very high returns on investment. During favorable economic times of bullish markets, growth stocks tend to prosper. No income tax is ever imposed on unrealized capital gains until you sell your shares, unlike dividends that are taxed upon receiving it. Drawbacks of growth stock investing. The only way to obtain your return on investment is to sell your shares. Until then, it's just paper earnings. A decline in stock price might swiftly wipe out those earnings. During adverse economic circumstances, growth stocks tend to underperform. This is because it's difficult to expand during a recession, and there's no dividend to attract investors. management doesn't always make the great investments. As a result, the money could have been wasted. So which is better for you, dividends or growth? The best choice is one that fits your investment profile. Time horizon and risk tolerance are one of the two most important variables in creating your investment profile. Overall, growth stocks are the superior long-term total return investment. However, a bad news headline or earnings report may also cause a very substantial drop in the share price, especially in the short term. On the other hand, if you want to focus on a continuous source of income with dividends while lowering the risk of investing, then dividend stocks are the better option. Or you can allocate your portion of your investment to both dividend stocks and growth stocks. It all depends on your investing plan. But the one thing that's definite is that the sooner you begin investing, the longer your money has to grow and multiply. But when it comes to holding the security, patience is your best friend. So why should we invest at all? Check out our video on the true effects of inflation and its effects on our assets and cash. Thank you for watching, and please subscribe for more videos.